Welcome back to the deep dive. Today, we are opening a file that sits right at this weird intersection of unbelievably impressive and, frankly, structurally terrifying.
That's a good way to put it.
We're looking at Artisan Partners Asset Management. The ticker is APM. And if you're just, spanning headlines or looking at a screener, this company looks like an absolute fortress.
It really does. I mean, on the surface, you have a firm managing over $181 billion. That's as of late 2025. Then you see a dividend yield that consistently turns heads, often sitting somewhere between 6 and, believe it or not, 10%. It just looks like a cash machine.
Exactly. It looks like the kind of stock you'd buy, tuck away in a drawer, and just live off the checks forever. But, and this is why we do these deep dives, when you actually peel back the layers, the story gets complicated. And it's complicated very, very quickly. We have a stack of research here, their latest quarterly reports, flow data, and it all suggests that beneath those record highs, there's a serious conflict going on. The stock market has been lifting their asset base up, but the actual clients, the people writing the checks, they seem to be heading for the exits.
It's the classic divergence between price and flow. The market is giving them this massive tailwind, but the customer base itself is, well, it's slowly eroding.
So the mission for this deep dive is pretty specific. We're not just reading you the earnings release. We're applying a, let's call it a skeptical buy-side lens to figure out one thing. Is Artisan Partners a long-duration compounder? Is this a business that will grow intrinsically over the next decade?
Or is it a value trap? Is it a melting ice cube that just pays you a nice yield while the business itself slowly evaporates?
That's the question. And we should probably be clear right from the start. The preliminary verdict we're exploring today is not investable, at least for a long-term growth thesis.
Right. And that might sound harsh for a company that is, by all accounts, very profitable and completely debt-free. But when we dig into the structural mechanics, I think you'll see why the quality of the operation might not be enough to save the stock's performance over the long haul.
Okay, let's unpack this. To really understand why clients might be leaving or why the growth seems to have stalled out, we first have to understand what Artisan actually is. Because they're not structured like a BlackRock or a T. Rowe Price, are they?
Yeah, not at all. They're incredibly distinct. Artisan operates on what we call the autonomous franchise model. And to get that, you really have to go back to the founding in 1994 with Andrew and Carlene Ziegler.
The Zieglers.
Right. They came out of a firm called Strong Capital Management, and they had a very, very specific philosophy. They believed that the best investors are essentially artists, hence the name Artisan.
Right, makes sense.
They believe that if you want to generate alpha, if you really want to beat the market consistently, you cannot have a top-down bureaucracy telling you what to do. You can't have some committee dictating your every move.
So it's the complete opposite of a massive firm, where the chief development officer sends out a memo saying, we're all bullish on tech this quarter, and then everyone just falls in line. Artisan is, what, a federation. A collection of boutiques.
A federation is the perfect word. Think of it less like a corporation and more like a film studio that funds a bunch of independent directors.
I like that analogy.
You've got the international value team over here, and they might have a philosophy that's deeply rooted in contrarian, old-school value investing. Then, in a completely different office, you have the growth team, and they might be chasing momentum in the tech sector.
So they could be buying what the other team is selling.
Absolutely. They have different processes, different cultures, and they act completely independently. They are their own little businesses.
They're franchises.
They are franchises. The corporate parent Artisan Partners proper just handles the plumbing. They do the distribution, the compliance, the legal work, the IT. They handle all the boring back office stuff. So the talent can just focus on one thing, picking stocks.
Which I imagine sounds like a dream for a top-tier portfolio manager. You get the scale and distribution of a big firm, but the freedom of running your own little shop.
It is a dream. And that's exactly why they've been able to attract such high-level talent over the years. But that talent and the model that supports it, it comes at a price.
The fees.
The fees. Because they sell active management, this idea of high-conviction stock picking, they charge premium fees. Their blended fee rate is around 69 basis points. That's 0.69% of assets.
And in a vacuum, 0.69% doesn't sound like a lot, but we have to contextualize that, right? We are living in a world where I can go buy an S&P 500 ETF for 3 basis points, or 0 in some cases.
Precisely. That is the hurdle. Artisan is charging a luxury price in a world that is rapidly moving toward commoditized, almost free pricing. Now, compare that to some of their larger active peers who might be charging 40 or 50 basis points. Artisan is positioning itself as a premium, high-value add product.
But that premium pricing, when it works, supports some incredible margins.
Oh, absolutely. The business model is beautiful from a financial perspective. We're talking about operating margins north of 40%. It's an incredibly profitable business because the overhead is relatively low compared to the huge pool of assets they manage.
Sure.
But, and this is the key to the whole story, that model only works if the assets stay in the building.
And to keep the assets in the building, you have to keep the stars happy. I was looking at their compensation structure, specifically these franchise capital awards. It sounds a lot like golden handcuffs.
It is exactly that. It's a very clever mechanism to bind the talent to the firm. They have a revenue sharing model where the investment teams get a significant cut of the revenue they generate. So if you run a successful fund, you get very, very rich.
So they have skin in the game.
A lot of skin in the game. But if a portfolio manager wants to leave, they have to leave a huge amount of unvested equity and deferred compensation on the table. It makes walking out the door incredibly painful financially.
So it aligns them. It stops a star manager from taking their track record and walking out the door to start a hedge fund next week.
Ideally, yes, but it also creates a double-edged sword. It reinforces the ideal that the individual is the brand, not the firm. Clients aren't really hiring Artisan Partners. They're hiring David Samra. They're hiring Dan O'Keefe. They're hiring a specific team. Artisan is just the platform that processes the billing.
And if that person leaves, the money often follows, regardless of the golden handcuffs.
The risk is that a lot of it follows, yes.
Okay, so we've set the stage on how they make money. High fees, star talent, and high margins. But now we need to look at the cracks in that foundation. I mentioned earlier that AUM assets under management is at an all-time high, $181.3 billion. If I'm just looking at a chart, that line is going up and to the right. Why are we calling this an illusion of growth?
Because in asset management, you have to break growth into two pieces. There's market growth, and then there's organic growth.
Okay.
Market growth is just beta. It's the tide rising and lifting all the boats. Organic growth is sales. It's the hard work of actually convincing a client to give you new money or to keep their money with you.
So if I manage $1 billion and the market goes up 20%, I now manage $1.2 billion, even if I sat on the beach all year.
Exactly. And that is the story of Artisan right now. Let's look at the numbers for the first 9 months of 2025, because they're really telling. Their AUM rose by over $20 billion.
That sounds like a banner year.
It sounds fantastic. You'd think management would be popping the champagne. But when you break it down, that increase included $27 billion in market gains.
Okay, so the market just gave them $27 billion.
Yes. But when you look at the flows, the actual money coming in versus money going out, they had net outflows of $7 billion.
Wow. That is a staggering difference. The market handed them this massive gift, and their clients were actually taking $7 billion off the table.
And this isn't a one-off. It's not just one bad quarter. This is a persistent, multi-year trend. In 2024, they had nearly $3 billion in outflows. In 2023, it was about $4.1 billion in outflows.
So when was the last time they actually grew organically?
That's the scary part. If you look back historically, the last year they had really meaningful organic growth where they actually brought in more money than they lost was arguably 2017. You can maybe count a tiny blip in 2021, but the trend line is clearly red.
So for the better part of a decade, essentially, the core business, the act of selling their product to new and existing customers, has been shrinking, while the bull market has been papering over the cracks.
That is the textbook definition of negative organic growth. I mean, the sales team is bringing in money, sure, it's not zero. But the existing clients are withdrawing it faster than the sales team can replenish it. The company is completely and utterly reliant on a bull market to hide the fact that its customer base is slowly eroding.
It brings us right back to that melting ice cube analogy you used.
It's a melting ice cube in a very warm room. The warm room is the bull market. It keeps the volume of water in the bucket looking high so you don't really notice the ice itself is gone. But if the AC kicks on, if the market goes flat, or God forbid, drops for a year or two, you suddenly see exactly how much mass you've lost. The water level plummets.
So why are they leaving? Is it just the fees? Or is the performance bad? I mean, are these star managers not delivering?
It's a mix of both, but the biggest headwind is structural. It's that industry-wide shift from active to passive management.
The Vanguard effect.
The Vanguard effect. Institutional clients, we're talking pension funds, endowments, they are ruthless about costs now. They look at their spreadsheet, they see they're paying Artisan 69 basis points, And right next to it, they can get a Vanguard index fund for almost nothing. Unless Artisan is consistently blowing the doors off the performance metrics, the map just favors the cheap option.
And are they blowing the doors off?
In some places, yes, absolutely, but in others, no. Some of their big legacy strategies, specifically U.S. mid-cap growth and global opportunities, have gone through periods of underperformance recently. And in the active world, performance is gravity.
Right.
If you lag the benchmark for 3 years, you get put on a watch list. If you lag for 5, you get fired. So they're fighting a war on two fronts: the big secular shift to passive and the cyclical performance issues in some of their older important strategies.
This feels like a perfect transition to what I think is the most critical risk factor in this entire deep dive: the concentration risk. We talked about the star system, but I was genuinely shocked when I saw just how top-heavy this company's asset base is.
It is incredibly concentrated. When you look at the breakdown of that $181 billion, it is not spread evenly across 20 different teams.
Yeah.
Not even close.
No, we are talking about one strategy in particular, the international value strategy.
Right. Managed by David Samra. He's a legend in the field, arguably one of the best international value investors of his generation, a true artisan. But his single strategy manages $52.5 billion as of late 2025.
Let me just repeat that. $52.5 billion, that's nearly 29% of the entire firm's assets in one strategy.
In one strategy, effectively run by one key decision maker. And it gets even more concentrated. If you zoom out just a little bit and add in the global value team run by Dan O'Keefe and the main growth team, just those 3 silos control about 80% of the firm's money.
That is terrifying. It's like a stool with 3 legs, but one of the legs is twice as thick and holding most of the weight.
And that thick leg Samra's team is basically the only mature equity franchise that is actively working right now. It was the only one really pulling in new money. It had about $680 million in inflows year to date in 2025.
So everything else is bleeding assets, and this one strategy is plugging the dam.
It's the only thing keeping the overall outflow number from being even worse. So you could argue the entire stability of the firm currently rests on David Samra's performance and his decision to show up to work every day.
I want to touch on the history of that team because it really highlights this risk. You mentioned Dan O'Keefe and David Samra. They used to be a duo, right? They ran a fund together.
They did. This is a fantastic case study in talent management. Before 2018, they were the co-PMs on the massive flagship global value team. It was an absolute powerhouse. But as often happens when you have two alpha personalities managing tens and tens of billions of dollars, tensions can arise.
Creative differences.
Maybe it was creative differences. Maybe it was about succession planning. Who knows? But it became clear that the partnership couldn't stay together in that form. The risk of one of them leaving was getting too high.
So what did Artisan do? Did they force one out?
No, they did something very artisan. They split the baby. In September of 2018, they divided the team. They basically said, okay, David, you take international value. Dan, you take global value. You're now separate autonomous franchises.
It's like a band breaking up, but both lead singers staying on the same record label as solo acts?
That's the perfect analogy. And to their credit, it worked. Both of them stayed. It prevented an absolute disaster where one of them left and took $20 billion to a competitor. But it just highlights the extreme leverage these stars have over the firm. If Samra had decided to walk in 2018, the stock price of APAM would have cratered.
And that risk hasn't gone away in 2025.
It's arguably worse now, because now Samra's silo is over $50 billion. So let's play out the nightmare scenario. What if he decides to retire tomorrow? Or what if his value style just goes out of favor and he underperforms for 2 years? Which, by the way, happens to every single value investor eventually.
Sure.
That pillar starts to crumble.
Mm-hmm.
There is no replacement of equal size waiting in the wings. If that $680 million inflow turns into a multi-billion-dollar outflow, the math for Artisan gets very ugly very fast.
It really just underlines the key man risk. You aren't investing in a brand like Coca-Cola or Apple where the institution is bigger than any one person. You're investing in a collection of specific human beings. And human beings retire.
Or they burn out.
Yeah.
Or they just lose their touch for a while. It's a much more fragile model.
So, okay. We've established that the organic growth is broken and the concentration risk is, frankly, terrifying. So why does anyone own this stock? The answer usually is the yield.
The yield chasers.
Right. Depending on the day you look at the share price, APM yields anywhere from 6% to 10%. That is a massive number in almost any interest rate environment. But you've labeled this section of our deep dive the dividend trap. Why is it a trap?
It's a trap because of the policy. Most companies, let's take a utility company or a standard blue chip, they try to pay a steady, predictable dividend. They might pay 50 cents a quarter, rain or shine.
Right.
They keep cash on the balance sheet to smooth things out during bad years. They want the dividend to be boring and reliable. The worst thing they can do is cut it.
A dividend cut is seen as a major failure of management.
Exactly. Artisan doesn't play by those rules at all. Their policy is to pay out about 80% of the cash they generate every single quarter. And then, once a year, they pay a special dividend to clear out whatever cash is left over. They essentially distribute 100% of their profits to shareholders.
So they are literally emptying the bank account every year.
Every single year. They run with very little retained capital on the balance sheet.
That sounds great if you own the stock. I mean, you get all the cash. It's extremely shareholder-friendly in a theoretical sense.
It's great in a bull market. In 2021, when markets were just roaring, they were paying out these massive checks, and shareholders were thrilled. But you have to remember, the revenue is tied directly to AUM, which is tied directly to the stock market.
So when the market tanks...
Their revenue tanks.
Mhm.
And because they pay out a percentage of their earnings, the dividend tanks right along with it.
We saw this play out in the 2022 bear market, didn't we?
We did. It was the perfect test case. The bear market hit, their AUM dropped 27%, and the dividend payout dropped right along with it. So put yourself in the shoes of a retiree. You bought APAM for that juicy income stream. Suddenly the market is down, inflation is spiking, and your dividend check gets cut by 30% just when you need the money most.
That is the worst possible correlation. Your income goes down exactly when your portfolio value is also going down.
It's a double whammy. It isn't a steady bond proxy like a utility stock. It is a leveraged bet on the stock market. We call it pass-through income. You are just getting the cash flow of the market passed through to you, minus the firm's fees. It's highly volatile.
And there's another more subtle side to this 100% payout policy. If they're paying out all the cash as dividends, they aren't using it for anything else, specifically share buybacks.
This is such a critical point, and it often gets missed. Artisan, like many companies, issues shares to their employees. We talked about how they attract talent. They give them equity.
Right, the franchise capital awards.
So the share count naturally creeps up by about 1% a year as employees convert their equity awards and new grants are issued. In a normal company, the firm would use its cash to buy back those shares on the open market to neutralize the dilution for existing shareholders.
But Artisan pays all the cash to you as a dividend.
Right, so they don't do meaningful share buybacks. They can't.
Which means shareholders are being slowly but surely diluted over time.
Yes. So let's combine all these factors. You're in a bear market. The stock price drops because the assets drop. The dividend check gets smaller because earnings drop. And your ownership stake in the company gets slightly diluted because the share count is rising.
That is the absolute textbook definition of a value trap. You buy it for the 9% yield, and then the stock falls 20%, and the yield gets cut to 5%.
Yeah.
You lose on every single front.
That is the nightmare scenario. And it's exactly why we say this isn't a set it and forget it kind of income stock. It requires you to be right about the market's direction.
No, surely management sees all this. They have to know they have an outflow problem. They have to see the concentration risk. What are they actually doing about it? Let's talk about their strategic transitions.
Well, there has been a change at the top, which is usually the first place you look for a strategy shift. Eric Colson, who was the CEO for a long time since 2010, basically moved to executive chairman in 2025. A guy named Jason Gottlieb took over as CEO.
Okay, who is Gottlieb? Is he an outsider brought in to shake things up? Did they, hire someone from BlackRock or a tech firm to reinvent the company?
No. He's the ultimate internal candidate. He was the president. He's been at the firm since 2016. He's steeped in their culture.
So this signals continuity.
Absolute continuity, which, is good for the culture. The investment teams won't panic. They know him. He understands and respects the Artisan way.
But if you are an investor looking for a radical turnaround or a pivot into ETFs or a massive merger, Gottlieb isn't that signal. His appointment signals steady as she goes.
But they are launching new things, right?
Yeah.
I saw they aren't just a pure stock-picking shop anymore.
That's true. They did realize a while ago that being 100% long-only stocks was a dangerous place to be, so they made a big move and launched a credit team back in 2014, and more recently, an M-Sites team, which is emerging markets debt, in 2022.
And looking at the data we have, the credit team is actually a huge bright spot. It's a massive bright spot. The credit team has hit $11.6 billion in AUM, and they've had 12 consecutive quarters of inflows. In a vacuum, That is a huge success story. They prove they can do something other than just pick stocks. They built a legitimate, high-quality, fixed-income franchise from scratch.
But I can hear a but coming.
But it's a math problem. The credit and EM debt strategies, even with all their success, are still less than 15% of the firm's total AUM. They are growing, sure. But the equity business, the other 85% of the company, is leaking billions of dollars a year.
It's like trying to fill a bucket with a teaspoon while there's a hole in the bottom the size of a dinner plate.
Precisely. The new bucket isn't filling up fast enough to replace the water that's leaking out of the giant old bucket. It helps damp down the volatility a bit, but it doesn't solve the core strategic issue, which is that the main equity franchise is shrinking.
It really feels like too little, too late, or at the very least too slow.
It's definitely slow. And this goes right back to their core culture, their wait-and-see approach. Artisan is culturally very, very conservative. They don't do M&A. They don't go out and buy other firms to acquire new assets or capabilities. They didn't chase the ETF boom. They didn't launch a crypto fund when that was hot.
Which, to be fair, probably protected them from some disasters. There were plenty of asset managers that blew themselves up chasing fads or overpaying for big acquisitions.
That's absolutely true. They avoided any big, dumb deals. Their conservatism has kept them out of trouble. But being that conservative also means they completely missed the biggest trend in finance of the last 20 years, the ETF revolution. They're just now trying to catch up with some alternative strategies, but they are fighting for scraps in a very crowded market. They aren't a first mover in anything anymore.
So when we look at the competitive landscape, how do they stack up? I mean, who are they actually fighting against day to day for client dollars?
Well, they're fighting everyone, from Vanguard to hedge funds. But the most direct comparisons are the other big publicly traded active managers. Think T. Rowe, price ticker TROOU, or Franklin Resources, which is Ben N, or Janus Henderson.
T. Rowe is really the big dog in that group.
T. Rowe is massive.
Yeah.
But more importantly, T. Rowe has diversity in its business model. Think about their product line. They have a gigantic suite of target date retirement funds. You know, when you sign up for your 401k at a new job and you just pick the Retire in 2050 fund.
Sure, it's the default option for millions of people, the money you put in every 2 weeks and never, ever look at.
Exactly. T. Rowe dominates that space. And those assets are incredibly sticky. They can stay there for 30 or 40 years. People don't trade in and out of their 401k every quarter based on last year's performance. Artisan has nothing like that.
Artisan is a pure play.
A complete pure play on active stock picking. They don't have a passive arm. They don't have a massive retirement chassis. They don't have a huge money market business. When active stock picking is out of favor with investors, Artisan has nowhere to hide. T. Rowe can lean on its retirement business. Franklin bought Legg Mason a few years ago to get huge into fixed income. Artisan is just Artisan.
It really does feel like they're the last of the Mohicans, just standing there with their stock charts while the rest of the world moves on to algorithms and passive flows.
In a way, yes. And to be crystal clear, they are very, very good at what they do. If we were to put together a final scorecard, their operations are strong. An A+, high margins, a fortress balance sheet, zero debt issues. They run a tight ship. If active management ever makes a massive permanent comeback, they are positioned perfectly to capitalize.
But that's a really big if. You're betting against a powerful secular tide.
You really are. So, for strategic vision, I'd have to rate it fair, maybe a C+. They're great at preserving their unique culture, but they've been very bad at finding new avenues for organic growth. And that brings us to investability and our final verdict.
The skeptical conclusion.
Right. At the end of the day, we have to look at this through the lens of a compounder. If you put $1 into this business today, will the business itself be bigger, stronger, and more intrinsically valuable in 10 years?
And the answer seems to be a resounding maybe not.
The answer is very likely no. So the verdict is not investable as a compounder.
Even with that big, juicy yield.
Even with the yield. Because, as we said, Artisan is a melting ice cube. It serves a purpose, but only as a cyclical income play. Look, if you have a strong view that we're about to enter a massive multi-year bull market for international value stocks, then sure, maybe you rent Artisan for a year or two. It's a leveraged bet on that very specific outcome. You'll probably make a lot of money in the short term.
But structurally, as a long-term holding.
Structurally, the headwinds are just too strong. The industry shift to passive isn't stopping. The concentration risk on one manager, David Samra, is uncomfortably high. And the dividend policy prevents them from defending the share price through buybacks during downturns.
It really is the difference between renting a stock for a trade and owning a piece of a business for the long term.
That is the perfect way to put it. You can rent Artisan for the dividend during a bull run, but you probably shouldn't marry it because the fundamental business-selling high-fee active management is in a state of slow structural decline.
Let's recap because we covered a ton of ground and a lot of numbers today. Let's try and boil this whole deep dive down to the four main points for you to take away.
Sure. Point number one, the AUM illusion. Remember that record assets are being driven by market inflation, and they're masking over $15 billion in cumulative client departures since 2018. The business is shrinking. The market is just inflating the balloon for them.
Okay. Number two.
Star risk. The company is dangerously reliant on David Samra's international value strategy. It's nearly 29% of all assets. That is a massive single point of failure that should keep any risk manager awake at night.
Number three.
The dividend trap. That high yield you see is variable. It drops when you need it most during market downturns. And the payout policy prevents share buybacks, which leads to slow but steady dilution of your ownership stake over time.
And finally, the fourth point.
No note. Their excellent performance history, and let's be clear, their long-term track record is excellent, still hasn't been enough to stop clients from switching to cheaper passive index funds. And if top-tier performance can't stop the bleeding, what can?
That's a really sobering takeaway. It's a company that does everything right from an operational standpoint. Great margins, clean books, really smart people, but they're playing a game that is just getting harder and harder to win every single year.
It's the best house in a bad neighborhood.
I like that analogy. So as we wrap up, we always like to leave you with a provocative thought, something to chew on. What's the big question here?
For me, it comes all the way back to that 100% dividend payout policy. I want you to ask yourself this. If a company pays out 100% of its earnings to you today, essentially emptying the register every year, are they admitting they have no good ideas for how to grow tomorrow?
Ooh, that cuts deep. Are they being generous and shareholder-friendly, or are they effectively giving up on growth?
Capital allocation is a signal from management. And this signal says, we don't really know what to do with the money to grow the business, so you just take it.
And on that bombshell, we are going to close the file on Artisan Partners. A fascinating look at a high-quality firm in a really tough spot. Thanks for listening to the deep dive. We'll catch you on the next one.
Thanks, everyone.